Hello Deep Valley community, thank you for watching, and as always this is our value investing journey, so please subscribe so you can get my next video installment. So let's get started. Today I'm going to talk about weighted average cost of capital and why it's an absolutely pointless endeavor to figure it out. But before that, let's actually figure out what it means. So this here is the formula for weighted average cost of capital. What does it mean in real terms? So a WACC formula is essentially the cost to the firm from the debt side and from the equity side. Okay, now, so this is the side for the debt with D there, this is the side for the equity. Side for the debt is pretty straightforward, just a mathematical calculation figuring out what is the cost of the debt to the firm. Okay, now for the equity side, it is really just an absolute guess. This is the reality, because I'm a value investor, so I'll just tell you how it is. This kind of formula serves two groups of people. It serves the sell side to justify in their reports why a stock is undervalued or overvalued by 10 or 15%. So put that aside. And it also helps for the MBA students and the CFA and the ACCAs and whatever to basically have something to do in school. Now, I'm a practitioner. I have no use for theory. Remember that quote? That an ounce of practice is worth a ton of theory. So let's get stuck in. The reason to calculate the WACC is to incorporate that into a discounted cash flow analysis, DCF. So I'm going to show you the problem with the DCF, and then I'm going to show you how I figure out whether something is possibly undervalued or not. So your purpose as an investor, your sole objective is to deploy capital today for it to be worth more in the future. Nothing else needs to take place. You don't need to buy it on the cheapest day, be a hero. You just need to buy an asset, whether it's a home, whether it's a business, for a price. You're putting down hard capital, hard savings today, and at some point in the future you realize the value of your investment, and that is it. So without further ado, let's get started here. So basically, if you go to, let's say this is Morningstar, and I look at a company such as Apple, okay, and you can see over the past trailing 12 months, Apple's made $12.70 in earnings per share. Okay, so you go onto this website. I use moneychimp.com, but you can use, it doesn't matter, you just type into Google DCF calculator and you'll find a zillion of them. So I just put here $12.70, because that was what was here, $12.70. And I said, okay, let's assume that the earnings are gonna grow over the next 5 years at 5%, and after that it's gonna go off and taper off at 3%. Okay, and I believe that the weighted average cost of capital discount rate is 8% for Apple. So you come here, you cross calculate, and it comes up as $2.85 per share is the value of the business, and you compare on any kind of financial website and you see $2.88. So you say, okay, Apple today is a fair price. But let's say you actually think, you know what, Apple is actually quite a risky investment, because it has only one product essentially, which is the iPhone. The iPhone is losing favor with consumers. If the iPhone is losing market share, this is the magic, quote unquote, that comes in. Let's say that you believe that the iPhone is not as cool as it was in the past, and actually the discount rate would be, let's say, 11%. In this example, the value of Apple shares has dropped to 177. So you'd say that the investment at the moment is overvalued. Okay, or you might say, you know what, Apple does have this funnel, which is the iPhone, But Apple today is not solely reliant on this single product. Apple today is pivoting towards a service business. Let's say you're going to say, oh, you know what, Apple, it's building that. It already has a very sticky ecosystem, but it's layering on top of that ecosystem. So now, if you want to kind of watch Apple TV, or you're going to get a new Apple device, and you're going to be further in that ecosystem. So it's service. As it becomes more of a service business, not so much of a hardware business, you're going to make the argument that its margins are going to be expanding going forward. Okay, now it doesn't seem to actually be transpiring at that level yet, but you could say going forward that its operating margins will be expanding. Okay, so you can make an argument. So you'd say, okay, the discount rate for a company that has net cash of 100 billion, so it's approximately 8% of its market cap is made up of cash. Its discount rate should only be, let's say, I don't know, say 6%. So then you get 477 as the value of Apple shares versus the 285. So you say, okay, you know what? If I fiddle around with the discount rate, I can actually get the result that I want. And that's a lot of what the sell side does to kind of publish a result. You know, if the sell side wants to kind of go with a certain angle, they would fiddle around the discount rate, because that's so subjective, and you can easily substantiate why it should be worth X or why it should not be worth Y, you know. So that's easy peasy, okay? So in the example of Apple, you'd come here, I'm just using Morningstar, but you can use something else, and you say, okay, over the past 5 years, people have been willing to pay 3.5 times Apple's price to sales, and you'd come here and you'd say, yeah, you know what, it's kind of like closest to fairly valued. And another, if the company has a dividend, I kind of like to see that, because that's a hard bit of cash coming out of the business. So in the past, the yield that investors were craving for Apple was demanded was 1.6%, whereas the yield now has compressed down to 1.1%. So you could make the argument in this case that Apple is not really offering you the bargain you want. So then you could say, what about, Mike, what about companies that don't have a dividend? So I've gone over to, this is a company, I have no position. I don't have any position in these videos, in these companies that I'm talking about. But you could say, okay, in the case of Facebook, I can see that the price of sales has really come down significantly. Yes, it does have a lot of problems with the Department of Justice coming out of it. It does have a ton of problems, but you can see that in this example, that on the price to sales ratio, it's really come down significantly. So investors are particularly feeling despondent against Facebook. So investors have kind of lost their enthusiasm, and the multiple has compressed down. So you want to buy into an asset when people don't want to buy. And the reason why investors don't want to buy something is because the outlook is not looking great. It's a cloudy outlook in the case of Facebook. Typically, there's a lot of uncertainty. Most of the times, the uncertainty is justified. As Buffett says, that the difference between being mostly right and being always right is the difference between night and day. Buffett talks about that card with 20 slots, and you can make, over the course of your lifetime, 20 investments. So you have to be really selective, because if you only have the ability to make 20 investments over, let's say, a 30-year period, you've got to be really, really thoughtful and reflective and humble, and you have to really think about what you're going to buy. So I hope you found this video useful, and as always, please subscribe and drop comments below, because this is Owl Valley Investing. Thank you for watching.